The global trade landscape is shifting, and the numbers don't lie. Import demand has plummeted below 2023 levels after a roller coaster first half of the year. But here's where it gets intriguing. What does this mean for the economy? And are we on the brink of a broader slowdown? Let's dive into the data and unpack the story behind the Freight Waves chart of the week, which highlights the inbound ocean TEUs volume index, IOTI. This index, tracking container bookings from global ports to the U.S., reveals a startling drop, about 8% below last year's levels, and nearly 14% below 2024 projections. The question on everyone's mind: has the import frenzy fueled by geopolitical tensions and trade policy uncertainty finally calmed? Or is this just the calm before another storm? The answer hinges on shippers' confidence in their demand forecasts and inventory management for the rest of the year. And this is the part most people miss. Despite ongoing legal battles over U.S. tariffs, with courts deeming portions illegal pending Supreme Court review, shippers seem to have adopted a more cautious ordering approach compared to the past 2 years. September, typically a post-peak slowdown month, saw this year's peak arrive unusually early, driven by shippers rushing to capitalize on temporarily suspended tariffs on Chinese goods. Inventory levels, as per the Logistics Managers Index (LMI), grew modestly in August, clocking in at 58.2 compared to 55.7 last year. While this suggests expansion, the pace of growth isn't exactly robust. Domestic transportation data paints a similar picture. Intermodal rail volumes inched up 1 to 2% year-over-year in August, but truckload tender volumes plunged by 10 to 15%. These figures point to softening goods demand, even as retail sales hold steady, though it's worth noting those numbers aren't adjusted for inflation. Here's the controversial part. Does the slow fall season spell doom for the holiday shopping period? Not necessarily, especially if inventory was stockpiled earlier, but it does hint at a broader cooling in consumer demand. Interestingly, the IOTI remains above the post-pandemic lows of late 2022 and early 2023, though year-over-year comparisons are muddled by irregular seasonal trends. Overall, import demand signals a subdued economic outlook for the rest of the year and possibly into early 2026. Unless consumers surprise us during the holidays, a moderate slowdown seems likely. But here's the twist. Waning demand doesn't automatically ease conditions for domestic transportation markets. The truckload sector, already in a 3-year contraction, is seeing carriers reject loads at higher rates as their networks become increasingly imbalanced. This volatility is already evident in the spot market, where rates fluctuate wildly, a pattern expected to intensify in November and December. Now let's spark some debate. Could a slowing goods economy actually make life harder for shippers? As freight demand cools, the already strained transportation market might become even more unpredictable. What's your take? Do you think shippers are prepared for this shift, or are we headed for more turbulence? Share your thoughts in the comments. Let's keep the conversation going. About the chart of the week. Each week, FreightWaves selects a standout chart from Sonar, a platform aggregating real-time freight market data from hundreds of sources. This week's chart, along with expert commentary, offers a snapshot of the industry's current state. For a deeper dive, explore Sonar's thousands of charts and maps, or request a demo to see how it can transform your understanding of freight markets.